When it comes to monthly averages for mining metrics, overall, we saw a slight rebound and improvement in mining economics, right? Hash price up over the month around 8.5%, Bitcoin denominated hash price up 2.7%, average Bitcoin price up by 5.6%. We did see from month start to month end, it rose around 10%, and average difficulty down around 2.7% throughout the month. Now, at the same time, when it comes to Wall Street, and we saw a strong month there as well. We saw that Bitcoin price recovered around 10%. At the same time, the S&P 500 returned around 10%, and the NASDAQ composite also returned 14%. These are some of the strongest months that these indices have seen since November of 2020. What's really interesting, though, is a lot of this upwards action was driven specifically by the tech sector. We saw a wide range of earning calls come in throughout the month of April, and a lot of them surprised to the upside, specifically in terms of forward guidance when it comes to capital expenditure for AI infrastructure. This reflected specifically on the semiconductor space. We saw that the ICE semiconductor index gained around 36% over the month, compared to Bitcoin at around 10%, the S&P at around 10%, and NASDAQ.
Don't compare it to. We're tired of this, man. Don't be comparing Bitcoin's returns to all these highfalutin AI stocks. I'm just joking, but when you sent me this chart, I was like, oh man, another quarter, another underperformance from Bitcoin over the last year, right?
Exactly. And what's cool to see is that obviously some of the publicly traded mining companies caught this bid as well. Our Bitcoin mining stock index, Hashrate index's Bitcoin mining stock index, was up 27% over the month. And the reason is because some of the constituents in this index are directly exposed. They're transitioning towards AI infrastructure companies. So they were able to catch some of this bid. Now, that's all the good stuff. There's a lot of green to talk about in there. But when it comes to network parameters, specifically network difficulty and hash rate, we continue to see a decline in average network difficulty. And in fact, at this stage, we are now 4 difficulty epochs in to being below the 1 zeta hash threshold for network hash rate. The equivalent in terms of difficulty for 1 zeta hash is 139.70 trillion. And we've now been below that level for coming up to 50 days.
So are you telling me, Khan, that we have officially exited the 1 zeta hash era, at least for now? I mean...
Yes, we are firmly below the 1 zeta hash level at this stage for 4 consecutive difficulty epochs. So that, I think, is the most surprising.
That's one of the more wild parts about this for me is just... We've covered it on the last time you were on talking about the Look Back series, but just how absolutely volatile Bitcoin's difficulty has been. And we're at this point where really hash rate is, if not plateauing, actually falling off the map. And you had a few notes about this in the summary you sent me, specifically about a quote here: marginal hash rate came offline at $30 hash price, has not returned even with hash price now near $39. I know it's hard to say, but do you think this is just miners quitting for good, saying it's just not worth it anymore? Do you think some of this might be miners moving equipment to lower cost jurisdictions, shuffling hash rate around? I know it's impossible, but if you could try to look into your crystal ball for us, what do you get a sense of like why that hash rate isn't coming back online, even if mining economics have improved?
Great question. And we don't know the answer, but thankfully there are a few data points which can give us a roundabout indication as to what's happening. And over time, we will find out. So we will have an answer. The most immediate data point that I would look at is the most recent difficulty adjustment, which took place on the 2nd of May. This was a downward difficulty adjustment of 2.3%. So what this immediately tells us is rather than seeing marginal hash rate come back online throughout the month as hash price improved, we didn't see this. In March, we did see this, right? We had the whipsaw in difficulty. There was a massive drop in difficulty, and then a very quick rebound, essentially back up to where difficulty was. The reason was because as soon as hash price popped in March, marginal hash rate responded very quickly. Within 24 to 48 hours, we saw that hash rate back block times went back down, and difficulty responded by adjusting back up. We did not see this on the 2nd of May. In fact, we saw difficulty went down. So this immediately tells us that marginal hash rate is not moving back in, and it points towards a continuation of structural decommissioning. Now,
Oh, sorry. No, finish your thought. I'll tack this on at the end.
So that's one point. But there are other data points that we can look into in the near future as we turn into Q3. Once we get to the end of June, beginning of July, we'll be able to see in our next quarterly global hash rate heat map whether there have been any moves in hash rate and whether trends have changed. If the US or North America loses some hash rate and we see other jurisdictions in emerging markets, low-cost power regions gain some hash rate, that will also give us some indication as to whether there has been a structural decommission and relocation towards other locations. And the final point I'll make is the hash rate forward market does indeed give us signals around this stuff. What we saw throughout the month of April, throughout this month, is the way that future hash rate contracts traded, we can back out implied expectations around hash rate and difficulty growth. And what we saw was that expectations for difficulty fell throughout the month of April by around 4% on average. So the forward market is also opining that hash rate and difficulty growth should be slowing down and going negative over the near future spanning the next 6 months.
Yeah, so basically hash rate traders are looking at the current state of the network, saying there's not really that much room for growth. All of the megawatts in the US, at least the bulk of them, are going to be going towards AI. So we expect forward hash rate to be worth much more than current spot hash rate. That makes a lot of sense to me. And I want to zoom in on that, but I just have one more question. I know there's like a lot of noise, obviously, with the AI pivots in terms of what's going on with Bitcoin's hash rate in the ASIC market. I mean, how much there's the argument that some of this is marginal hash rate that can't come online anymore, or which just is not worth the effort because maybe the margins aren't even fat enough at 39 or dollars per petahash per day. But how much of it do you think is also these Bitcoin miners decommissioning for AI? I mean, we were looking at the Q1 numbers for Iron, and we're going to look at the others for Core Scientific, is I think the other big, and TeraWulf in terms of AI revenue, the big gainers for Q1. And they've really ramped up their AI revenue, and it showed that they really started scaling down Bitcoin mining. So how do you factor in that noise? Do you think that's playing a significant portion of the current hash rate decline we're seeing?
That's a good question. Yes, I do believe that that has an influence and a role to play. And the reason is because we track the proportion of network hash rate that publicly traded mining companies represent of the overall global hash rate. And that has gone up over the past year or so. And I think it peaked at around 40% of global network hash rate. Since then, over the past quarter especially, it has declined somewhat. But that points to the fact that this has a significant influence, right? As compute revenues, general purpose compute revenues, are more attractive for these data center companies, they are now transitioning their hardware, which inadvertently creates a lot of opportunity for the rest of the mining network. As ASIC market dynamics are now changing, secondary markets are flush with new supply, prices are down. So this gives smaller, more modular mining operators a lot more opportunity and flexibility to now re-engage in the mining market as some of the larger players are transitioning away towards general purpose compute. So yes, I do think that we're seeing this clearly in the data.
So Khan, as a closing question, I want to go back to the hash rate derivatives market. And you mentioned in the post that the regime flipped where USD outperformed BTC contracts. This to me seems like a logical result of the fact that difficulty has been whipsawing everywhere. Is that your take on it? And also, what other trends can we unpack from this, other than, like you said, forward hash rate expectations are much higher than spot currently?
Definitely. So if you take a look at our look back, we provide 2 timeframes for rolling hedge performance. And coincidentally, the month of April 2026 is a nice window to look at because we're halfway across now towards the next halving, and our timeframes align actually. So on the one hand, we have a trailing 12-month time frame looking at results from May 2025 to April 2026, which is what you're seeing right there. And then we have the since halving timeframe, which aligns nicely because that's from May 2024 to April 2026. So on the one hand, we have a 1-year time frame, and now we have the 2-year time frame as well. There's two key things that we can take out from these pictures. The first is, regardless of contract denomination or hedge horizon, hedging against hash price has made sense over the past year and over the past 2 years. Whether it's US denominated or BTC denominated, whether it's 1 month or 5 months, we see all across the board that hedging hash rate has made sense. So that's a clear takeaway for mining operators from this picture. The second is there's a difference in the regimes that we see between the two timeframes. So if we look over the past 2 years since the 2024 halving, Bitcoin denominated hedging strategies stand out. And the reason is because we've seen secular growth in difficulty from the 2024 halving onwards up until Q4 of 2025. We hit the 1 zettahash milestone in September, and then Bitcoin price peaked in October of 2025. But then the story changed. Since then, we've seen an unexpected decline in average network difficulty. Difficulty is going back down. We're now firmly below the 1 zettahash milestone. And at the same time, Bitcoin price action has become uncertain and volatile. These results show directly in those two pictures. The 1-year time frame, USD denominated hedging stands out. The 2-year time frame, Bitcoin denominated hedging stands out. So we've moved from a difficulty growth regime into a Bitcoin price uncertainty regime now. So that's the second key takeaway. For astute, sophisticated mining operations that continuously monitor the forward market, these are clear signals for dynamic decision making. You know, at some point, the vibe shifted from growth and difficulty to unknown Bitcoin price action. And miners that followed these signals and acted on them would have stood to make significant gains versus spot mining. So I think those are the two main stories to take out from this.
CleanSpark is a market-leading data center developer with a proven track record of success. NASDAQ CLSK.